Hey traders, welcome out to the options report. This is Tyler. Hey, let's talk fundamentals, okay? I don't often get to talk about fundamental analysis, so here's what I'm thinking today. Little lesson on the PE ratio. One of the silver linings of the market sell-off is prices are dropping. And if the economy is still strong and earnings still stay firm, that means that the stock market is cheaper because it's a lower price, but same earnings, okay? So the best case scenario is all of this tariffs and trade war junk doesn't materially impact earnings, okay, so earnings kind of stay firm. And then the drop in price of the stock market, okay, makes assets cheaper. You know, from a fundamental perspective, it lowers the valuation of the stock market. So we're going to talk about that in the write-up today. But that's your silver lining. The concern would be if the stock market dropping in price is essentially predicting that corporate profits are going to be hurt significantly by all the trade war stuff. Then, you know, the stock market's not becoming cheaper, because if earnings are dropping to measure it with price, then really the valuation could be the same, right? So the best case scenario is we get a big drop in price, but corporate profits stay firm. And then that undervalued market, the market becoming cheaper, eventually becomes a great buying opportunity and is probably temporary, right? Probably temporary. So normally when you think about corrections versus bear markets, most major bear markets are accompanied by a big drop in corporate profits. Temporary downturns are usually sentiment driven, and as long as you don't see earnings deteriorate, usually the stock market recovers from those. Okay, so we'll talk more about that in the write-up, but there's your little intro to the PE ratio and markets becoming less expensive. Okay, there's your silver lining if you're grumpy about the stock market. At least it's getting cheaper.